The dull ache of the alarm clock. The weary trudge through yet another long day. What if you could wave a magic wand and make the 9-to-5 grind disappear? Imagine if your investments could generate enough passive income to afford you the freedom and flexibility to live on your own terms. No more asking for time off or scramble to pay this month's bills, just the liberty to spend each new day however you choose. It may sound too good to be true, but a select group of covered call ETFs can help turn financial freedom from a distant dream into a welcome reality. In this video, we'll walk you through 6 of the top income-generating covered call ETFs. We'll show you how a $10,000 investment in these funds could snowball over 10, 20, or even 30 years, putting the power to take charge of your life squarely back into your hands. Additionally, I'll cover one special fund that could potentially turn a $10,000 starting stake into millions down the road thanks to the power of compounding. By the video's end, you'll have a tailored portfolio strategy designed to deliver consistent, risk-managed dividends year after year, creating lasting income you can actually live off. If you're ready to take control and say goodbye to the shackles of a traditional job, join me as we crack the income investing code together. The first steps towards real freedom starts now. Covered call ETFs have been growing in popularity among investors looking for consistent monthly income. But what exactly are they and how do they work? A covered call ETF is an exchange-traded fund that invests in a portfolio of stocks and other equities, while simultaneously writing and selling covered call options on those same stocks. The goal is to earn income from 2 sources: the dividends from owning the stocks, plus the premiums collected from selling call options. When a covered call option is sold by the fund manager, the buyer of that call option pays an upfront premium and has the right to purchase the underlying shares at a set price, called the strike price, over a set time frame. If the share price stays below the strike price at expiration, the option buyer would not exercise the option and the fund pockets the premium as profit. If the share gets called away, the fund profits from selling at the strike price. Over time, a covered call strategy allows funds to generate higher yields compared to owning the stocks outright. Top covered call ETFs, like the ones we'll be discussing, target 7 to 10% or more in cash flow annually. This can translate into a very healthy monthly income stream for investors in the fund. Now that we've covered the basics, let's examine some of the best covered call ETFs working hard right now to deliver consistent cash to investors. I arranged this list from modest to some of the highest dividend yields in the market right now. Starting at number 6, we have Global X S&P 500 Covered Call ETF, ticker symbol XYLD. XYLD is a popular ETF investment choice that attracts investors with its monthly dividend payouts and a robust dividend yield of 9.37%, which it has consistently maintained. Should you invest $10,000 in XYLD and reinvest the dividends, your investment value would climb to $25,300 in 10 years, with an annual dividend of $2,266. The growth continues over time. In 20 years, that investment would increase to $64,660, bringing in an annual dividend of $5,760. After 30 years, your initial $10,000 investment is projected to soar to $164,450, which would generate an annual dividend of $14,655, or roughly $1,221 per month. XYLD, which operates similarly to its siblings ETF QYLD, targets the S&P 500 to provide income. It demonstrated resilience by outperforming similar funds, especially last year when major indexes like the S&P 500 and NASDAQ faced significant decline. It has successfully preserved capital while securing double-digit yields. XYLD strategy includes investing in the S&P 500 stocks and selling call options, a tactic that ensures a steady monthly income beyond the dividends. Impressively, since its inception in 2013, XYLD has consistently paid out dividends monthly, making it an appealing choice for those focused on cultivating future income streams. At number 5, we have the Global X NASDAQ 100 Covered Call ETF, which trades under the ticker symbol QYLD. This fund offers you a chance to earn dividends every month while reducing some of the risks associated with investing in large American stock index. It boasts an impressive monthly dividend yield of 9.84%, significantly outpacing inflation and surpassing returns from common investments like the S&P 500. With this yield, if you invest $10,000 in QYLD and hold on to it, in 10 years your investment could grow to $26,644, yielding an annual dividend of $2,487. Fast forward 20 years, and that same investment could increase to $70,991, delivering an annual dividend of $6,662. In 30 years, your initial investment of $10,000 could potentially balloon to $189,151, providing you with an annual dividend of $17,650, or around $1,471 per month. QYLD employs a covered call strategy by investing in the NASDAQ 100 tech giants and selling short-term options to generate extra income for its shareholders. The fund primarily invests in major tech companies, with industry leaders like Microsoft and Apple making up a large portion of its holdings. What makes this fund stand out is its SMART score of 8 out of 10, indicating that it's a favorable pick among investors. Additionally, Wall Street experts forecast that its price could increase by approximately 133% from its current level. Next on the list is the JPMorgan Equity Premium Income ETF, which carries the ticker symbol JEPI. This fund has quickly become a major contender in the dividend ETF market, amassing an impressive $25 billion in assets in under 3 years. In fact, it ranks as the third largest ETF in terms of net flow this year, which contributes to the substantial annual dividend yield of 10.3%. If you invest $10,000 in JEPI and maintain your investment, in 10 years, your investment is expected to increase to $27,151. Fast forward 30 years, and an initial investment of $10,000 could grow to a remarkable $200,152, offering you an annual dividend of $19,026, or approximately $1,585 per month. JEPI employs a distinctive approach by combining undervalued, low-risk S&P 500 stocks with equity-linked notes, a type of covered call strategy on the S&P 500. This blend results in an ETF that focuses on large cap equities with a priority on value and stability, targeting impressive yields. JEPI is known for its consistently high yield, often exceeding 10%, and it has a solid track record of mirroring S&P 500 returns, but with lower risk. This makes it attractive to both long-term investors and those seeking income. Unlike many funds that provide quarterly distributions, JEPI stands out by offering monthly distributions and charges a reasonable expense ratio of 0.35%, considering its specialized strategy. Next, we'll introduce the sibling of JEPI, the JPMorgan NASDAQ Equity Premium Income ETF, which is traded under the ticker symbol JEPQ. This fund too boasts an impressive dividend yield of 11.5%. With JEPQ, if you invest $10,000 and hold on to it, the projections are quite favorable. In 10 years, that $10,000 investment is expected to grow to $31,409. Fast forward 20 years, and the value of that investment could reach $98,650, yielding an annual dividend of $10,669. In 30 years, your initial $10,000 could increase to $309,871, delivering an annual dividend of $33,511, which is $2,792 monthly income. So, what's JEPQ's strategy? It operates similarly to JEPI, but with a focus on the tech sector. JEPQ zeroes in on large cap US growth stocks within the technology industry. Though a newer player, having launched in 2022, it already manages $1.75 billion in assets and pays dividends monthly. JEPQ sets itself apart by not adhering to the typical ETF playbook to achieve its high yield. It allocates up to 20% of its assets to equity-linked notes, ELNs, and engages in option selling on stocks, which serves to generate monthly income and temper volatility in pricing. Next up is the Credit Suisse X Links Gold Shares Covered Call ETN, traded under the ticker symbol GLDI. This is a covered call ETN that follows the GLD ETF, which in turn holds physical gold. The way GLDI works is intriguing. It not only tracks the GLD ETF, but also adds a layer by selling covered calls on the underlying gold. This means while GLD holds the actual gold corresponding to the funds it manages, GLDI capitalizes on this by selling an option on the gold each month to lock in potential profits. This creates a profit ceiling for the month, exclusive of the dividends. This strategy explains why GLDI may not perform as strongly as GLD during a bull market for gold. When gold prices surge, GLDI's gains are capped due to the covered calls, unlike GLD, which can fully capitalize on the price increase. If you invest $10,000 in GLDI and reinvest the dividends, after 10 years, your investment would be worth $39,088, providing an annual dividend of $4,981. In 20 years, the same investment could appreciate to $152,786, with an annual dividend payout of $19,470. Looking even further, in 30 years, an initial investment of $10,000 could potentially grow to $597,000, yielding an annual dividend of $76,108, or about $6,345 per month. Before finalizing the portfolio, consider the Credit Suisse X Links Crude Oil Shares Covered Call ETN, traded under the ticker symbol USOI. This investment has a notable dividend yield of 23.02%. Let's explore what USOI offers. This ETN is a way to invest in the crude oil market, tracking the performance of the USO ETF with an added benefit. It sells call options on USO at a price approximately 6% higher each month, trading some potential price appreciation for a consistent dividend yield. USOI's strategy mitigates the impact that monthly future contract rolling in USO might have on profits when oil prices are rising. If you invest $10,000 in USOI and hold on to it, in 10 years your investment could increase to $112,464, with an annual dividend of $24,175. Looking 20 years ahead, that investment could surge to $1,264,809, yielding an annual dividend of $271,867. In 30 years, your initial $10,000 investment with a 27.2% yield could grow exponentially to $14,224,511, providing an annual dividend of $3,057,521, or about $254,793 per month. While these projections are attractive, it's important to remember that such high yields may not always be consistent. To achieve more stability and potentially reliable returns, it's common strategy amongst experienced investors to diversify with a portfolio that includes various ETFs. This portfolio might include XYLD with a 9.37% yield, QYLD with a 9.84%, JEPI with 10.3%, JEPQ with 11.5%, GLDI with 13.71%, and USOI with a volatile but high 27.38% yield. By averaging the yields of these 6 ETFs, you get an average portfolio dividend yield of 13.63%. Based on this, if you invest $10,000 in such a diverse portfolio in 10 years, it could grow to $31,816, offering an annual dividend of $3,477. In 20 years, the value could be $101,229, with an annual dividend of $11,063. And after 30 years, the initial $10,000 could be worth a significant $322,076, amounting to roughly $2,933 per month. This strategy provides a more realistic and consistent outcome than relying on a single high-yield investment. In this video, we explored the 6 best covered call ETFs to invest in for the long haul. However, if your interest leans more towards investing stocks and index funds, we've got you covered. Check out our other videos on the topic dividend investing, where you'll discover strategies to potentially earn significant returns.